Welcome to the special presentation this week titled Automating Firework Stocks. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be your presenter this evening. Every fireworks season makes us think of firework stocks making explosive moves higher. Finding firework stocks is a cherry-picking process using the Unisearch tool to find candidate stocks and verifying their selection by looking at their graphs. Subscribers who've been following these presentations for more than a year may recall last year's presentation titled Explosive Profits with Firework Stocks, published on July 7th, 2017. If you're unfamiliar with this approach, please refer to that presentation for more in-depth information, including additional resources in our historical essays. To keep this presentation of reasonable length, I want to build on that presentation that we did previously. We finished that presentation by suggesting that you might consider automating the management of these trades in the Portfolio Manager. First, let's briefly build some context for this week's presentation. And as we often do, it all begins with an essay from our founder, Dr. DiLiddo, written July 1st, 2005. I've gone to that essay here in the Views tab, and the essay was titled Finding Firework Stocks. Every time the 4th of July comes around, I start thinking about explosive low-price stocks. I get more pleasure out of owning a stock whose price doubles, triples, or quadruples in a matter of weeks than I've ever had from watching even the most wonderful fireworks display. Don't get me wrong, I like watching fireworks displays, but when I do, it reminds me of owning explosive low-price stocks. Okay, so how do we find these stocks? Well, we run a search called Firework Stocks located in the Delta Search's Stocks group of Unisearch. And we're going to look at their graphs because big winners had virtually the same chart pattern, a long period of flatlining, a breakout to a new high on high volume, and a succeeding new high. The beauty of using these searches is that a good stock will show up more than once because it hits repetitive new highs on price on high volume. I can't tell you how important it is to look at this chart pattern because most of the low price stocks hitting new price highs on high volume will not continue to go up for very long. When, however, you find stocks that were dormant for a long time, then explode upward on high volume and repeat the act, you're on your way to finding firework stocks. So that's how we find them. Our focus this week, though, is on how we manage them. In our original presentation, we discussed the fact that these high flyers often crash quickly, so we need a trader's approach to managing them. In that presentation, we presented several solutions. First, charted solutions using a short 2 moving average, like a 10-day moving average, prior day's close, prior day's low, red candle low, trend lines. In other words, charted solutions, all based on short-term price movements, and on portfolio manager stops, prior day's close, prior day's low, and average to range. And of course, we also discussed options because option straddles make a lot of sense with explosive firework stocks. So tonight we're going to focus on the portfolio manager stops. We'll automate our trading plan in the back tester. If you need more information on how to develop a trading plan using the back tester, let me refer you to an excellent presentation done by Steve Chappell titled How to Find the Best Searches. In the second half of this presentation, Steve shows us how to develop a trading system around a selected search. And that brings me to my final point of order here. The firework stocks technique is a cherry-picking technique. For our tests, we're not cherry-picking, we're blindly trading the stocks that come to the top of the search results. We're also closing and opening positions at the next day's opening price. So we strongly suggest paper trading your system with live market data in the Portfolio Manager as the next step after the back tests. Let's move into the program. Here we are in the Unisearch tool. And let's find in the Delta Search's Stocks search group the search firework stocks. Here are our search parameters that we're going to test. We're looking for the stock's price, percentage change, that's our delta operator, over the last 26 weeks. And we're going to sort it descending. So the top of the sort list will be the stocks that have made the biggest change in their price over the last 26 weeks. We want them to be priced greater than $1, have more than 100,000 shares of average volume, and the rest of our Derby-ready criteria. For my backtest settings, you can see I set my initial investment at $50,000, reflecting the idea that on this aggressive approach, you might use a smaller portion of your holdings. We're still paying a commission of $9.95 per trade and not using margin. The first question I like to answer is, which market timing signal works best with this particular strategy? Let's look at the setting details of our trading system. So we'll make our first pass using confirmed calls. On the up signals, we'll use the Firework Stocks search, no stop criteria. We're going to trade 5 positions. Again, this is a trader's approach, much more active. We'll not automatically replace any of our positions. We're not going to limit the number of positions opened in a day. We're not going to close any open positions when we enter this situation. As we scroll lower, we're going to invest the average portfolio value in each position, buying odd lots, and not repurchase the same stock for 1 day after the sale. We'll not limit industry and sector diversification because we really don't anticipate a long holding period for this trading methodology. And we'll have a maximum percent of a stock's average volume at 1%. This helps us avoid taking overly large positions that might actually move the market. And then finally, when the confirmed down call comes or the down signal comes, we'll move to cash. So my first run is to just gauge the native performance of the search with no money management, just buying and selling on the timing signals. Let's look at the results. For my test bed, I selected dates from the beginning of 2016 to current, which in this case was the end of last week when I started doing my tests. And you can see that I ran a test of each of the market timing signals. And we can see that clearly the primary wave outperformed everyone else, which makes sense because these high flyers crash quickly, and the longer we hold into the downtrending market, the greater would be the pullback. So the primary wave is my timer of choice. Our next step is to start looking at stop loss combinations. For my first set of tests, I ran combinations from a 50% gain, 25% loss, all the way down to a 20% gain, 10% loss. In particular, I found when raising my gain stop above 50%, getting up into 75, 100% winners, my performance actually fell off as my fireworks burned out before they reached that profit target. Keeping with that theme, the sweet spot was a combination of a 20% gain, a 15% loss, where we took our profits early, gaining a 51% winning trade percentage, a 78% gain, which annualizes at 31.75%. It also had the smallest drawdown at 21.97%, but notice also all of these drawdowns are in excess of 20%, and that volatility is often a trade-off we make when we try to be more aggressive, chasing higher gains. My next test was to run a series of trailing stops. Here we see I tested a range of trailing stops from 20% to 5%. The best performer, the 20%, slightly underperformed our previous leader at a 62% gain, only 50% winning trades. A 25% annualized rate of return, but a higher 30.94% maximum drawdown. We're still going to cash when the primary wave changes to down, so we're closing those positions. But by using the trailing stop, we're allowing these high flyers to fall back from their highs, slightly underperforming, capturing those gains early. For my next study, I used a series of profit locker stops, ranging from a 50% target, 20% stop combination, all the way down to a 20% target, 15% stop combination. And the combinations I selected were informed by the results I got from my previous runs. So we see the combinations are all below 50% profit target, but also remember that our stop losses tighten as we build profit in the position. Our best performer, the 50-15 combination, had a 50% winning trade percentage, had overall gains of 96%, annualizing at 39%, with a maximum drawdown of 21%. A nice improvement over our top performer with a similar drawdown, but an overall gain of 96% versus the overall gain of 78% in our initial run. Also worth noting here, though, is our combination of a 2015 profit locker stop combination, a 51% winning trade percentage, so slightly better than our 50-15 combination. We underperformed on a percentage gain basis while maintaining a similar max drawdown. So slightly better performance in terms of finding winners, but the 50-15 combination making the best gains overall. I would also note, if we take off our signals and maximize our equity curve, I like that the portfolio has been able to make successive highs over the test bed. So overall, very nice performance using what I would call our more conventional methodologies for our money management rules. But as we suggested in the introduction, these firework stocks make explosive price moves and lend themselves to more non-conventional stop-loss methods. In particular, let's hit our copy button and we'll customize our trading system. And if I go into the automation rules and go to the stop criteria tab, we have in this box all of the available stop criteria that we can use within the back tester. And in particular, we talked about using the prior day's closing price, the prior day's low price, and a trailing average true range stop price. These three methods follow price action much more closely and are well suited for short-term trading approaches. Let's begin with the prior day's close. This stop criteria will be met when a stock's price drops from the prior day's close price by the amount entered below on our sliding scale. Our default setting at 5% then would set a stop loss 5% lower than the prior day's closing price. Remember, as these stocks explode, their daily range often explodes as well. So I want to test a range of sensitivities to that price action. Let's take a look at the results. Here you can see I tested a range of sensitivities from 7% to 4%. The sweet spot right in this 5 to 6% range. While we had positive results, we underperformed our benchmark with a 46 to 47% winning trade percentage, a 42 to 45% total gain, annualizing at 17 to 18%, and here's the kicker, a 33 to 35% maximum drawdown. So let's move ahead to our next method. We'll strike a copy, and this time we'll use our prior day's low. So instead of using the closing price, we'll use the low price from the previous day's price action. This stop criteria will be met when a stock's price falls below the prior day's low price at the close of the market by the percentage entered. So by default, if our price action falls 3% below the prior day's low, we'll trigger the closing of the position. Here I found the best results if I deactivated intraday stops and only looked at the stop criteria on an end of day basis, which means instead of closing out the position because price tagged that value, it actually had to close below the prior day's low price. Let's take a look at the results. Positive results again across the board. I tested a range of 3% to 1%. On an end of day basis, our best performer was the 2% below the prior day's low. 46% winning trade percentage, 73% overall gain, averaging at 29% annualized, with a max drawdown of 29%. The equity curve struggled a little bit in the late 2016 to late 2017 timeframe, is really taking off though from the end of 2017 through current. And now I'm excited to show you our final trading methodology, the average true range stop. So strike a copy, customize the system, and let's change our stop criteria to the trailing average true range. This stop criteria will be met if the stock's price falls by the multiplied average true range amount from the highest price the stock has reached since the trailing ATR stop was implemented. And we're offered two variables: the look back period, set by default at 10 days, and the multiplier by default set at 1. So to understand how these work, let's take a moment to talk about average true range. Here we have a graph of TNDM, one of our firework stocks candidates. And we see our behavior where we're looking for this spike in volume that coincides with a price breakout of a channel. And as Dr. DiLiddo noted in his views, looking for that pattern to repeat. And so we can see that it happened here, and it happened here, and it happened here, and most recently happened here in the end of June. Let's zoom in on our most recent time frame. Just left click and drag. I'm going to add to our graph layout under technical analysis the average true range indicator. By default, it has a look back period of 14 bars. So what this indicator is telling us is that the range between the high and the low price over the last 14 days on today's data has been $2.05. We can graph that average true range by simply checking the box. And notice that as price action broke out and accelerates, our average true range value is also increasing. But remember, the day's data point is governed by how many bars you're including in the average. So if I shorten the average or shorten the look back period, I make the average true range indicator more sensitive to current price action. So let's apply this now to our backtest settings. Because I'm trading these explosive price moves with shorter holding periods, let's reduce our look back period from 10 bars, and let's take a look at the results. Again, all of my results favorable. My variable in this setup was the multiplier. I did 1x, 2x, and 3x multipliers of that 5-day ATR. Our best performer delivered a 52% winning trade percentage, an overall gain of 144%, an annualized rate of return of 58%, with a respectable 22% maximum drawdown. The equity curve hits a series of higher highs, even through the more difficult 2016 to 2017 time frame. So let's minimize our equity curve, and let's resort our database by percentage gain loss. Now we can see the top performers relative to each other. And we see our ATR stops, both the 5 and 10-day ATRs, well outperformed the rest of the group. So what's our next step? Remember, this process of developing the trading plan is one where we're whittling down to a finer and finer degree the rules of our trading system. The backtester is using end-of-day data, applying the stop criteria to the open, high, low, close data points, and filling the position on the next day's open. So the next level of refinement would be to put these trading systems in a real-time environment. And so I would select a few of my top performers and convert them to Genius portfolios, just as Steve demonstrated in his presentation from June 15th. I'll add a 00 to the title of my portfolio so that it sorts to the top of my list. We'll continue from the end of the backtest, and I'll click OK. We see it brought the portfolio forward to the current date. There's our current holdings with our stop criteria applied, and now I can track the performance of that portfolio as it executes the trading plan in real time. The Backtester and Portfolio Manager are fantastic tools to help us refine our trading systems. Both can provide invaluable insights, whether we're trading firework stocks or top VST stocks. I thank you for watching.